freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, how are you today? You look like you're in nature.
I am in nature, but luckily today we actually in the middle of nature. I have faster internet than we do at my home in the city. So
I think that says something about you just need to pay for more expensive internet, is what that says.
Yeah, I pay for the bottom tier of Comcast, but it gets me by. So
well, I guess as long as it works. No, it looks very nice there. So I guess
it's nice. I'm up in Bend, Oregon, enjoying a little bit of a family trip, and went to the water park this morning and been doing my calls from a nice deck out here and just enjoying things.
Nice. Well, that's good. There are worse places to be taking calls and doing a podcast and all the stuff.
There are.
Cool.
So, and up in Oregon, you probably haven't been to one, but there's a chain of restaurants called the McMinimans, or they're all like McMinimans so and so. And that's a family, and they take old buildings and convert them into restaurants, hotels, bars, things of that nature. And so there's one in Bend that's an old schoolhouse that's converted to a restaurant and a bar, and they have a cigar shack and then outdoor fire pits all over the place. And it's really fun. I love going there. So got to go there on the first day up here.
Very nice. Yeah. I've been to Oregon once in my life. Tennessee, University of Tennessee played the University of Oregon, like, gosh, it's 12 years ago. I flew out there.
There's a McMinimans in Eugene.
Is there?
Mm-hmm.
There's a well, I won't tell that story. Sometime if anyone who's watching wants to hear the story about the time I got a recommendation for a local restaurant in Eugene from a local, and the recommendation was Applebee's. I'll tell the full story. If you ever reach out and email me or something, I'll share that full story. So yeah, we had a good time. It was nice until our flight got canceled and we had to figure out. My dad and I had to drive at like 2 a.m. up to Portland because it was the only way we could get flights back out.
Yeah.
So, yeah, it was a fun time. But we had a great time. We lost. That was when Tennessee was really bad and Oregon just beat the pants off of us. It was really bad. But everybody was super nice to us, so that was good. It's my only Oregon story. All right. Well, enough about Oregon. Which, by the way, I've heard people pronounce it as Oregon.
No, that's wrong.
And that's just wrong. Like, I want to say that for the record. Yes, for the record, it is not Oregon. It is Oregon.
It's Oregon. Yeah.
Okay. All right. Well, you had an idea for something to talk about today. What you got?
Yeah, I was thinking that would be a fun discussion to talk. When you first start talking to a limited in partner or passive investor and you start pitching a deal, I find even if they're really experienced, they will, you say, oh, well, there's the profit, and then it gets split 80-20, 20% to the managing partners, 80% to the investors, or whatever that split may be. And I'm like, whoa. Why are you taking 20%? And I think there's a lot of value actually in the general partners. For one, they're getting paid for the service they're providing, right? It doesn't mean that they don't have money in the deal. They might have money in the deal, paying themselves 80% of that profit, right?
Yep.
Or 20% of the profit there, and their capital is getting the 80. It follows the same rules. But I think a lot of it comes down to alignment. So I have a handful of notes on here. Is there a direction that you'd want to go, or something that you have off the bat?
No, I think that's great. I mean, I've encountered this as well, especially from folks who, if they're investing, I think I've encountered that the most from people who have previously either flipped houses or have owned single family rentals outright. And you're exactly right. There's this initial like bristling, or they have a problem with like, wait a second, you're going to own 20%, and they just don't want to share. Right.
Mm-hmm.
And that can be a blocker for people, again, especially if you're used to like, you want to own everything and have control.
Part of that comes down to the transparency that there is in these deals that are outlined up front, right? Because we outline, this is how we get paid. I mean, when we give an investor a spreadsheet, it shows where we get an acquisition fee, where we pay the splits, if there's a refinance fee, any of those things are all laid out there. They're like, oh, you're getting paid a lot to put this thing together. I'm like, well, I only get a lot if it performs. But second to that, I mean, when you look at your brokerage statement on a 401k, you don't see all the fees. And let me guarantee you, all of the people managing your money at Fidelity are getting paid. Normally the same, very comparable thing, 2 and 20 is pretty standard. 2% asset under management, 20% of the profit. And I think that's similar to kind of where we structure our deals. It's a 2% origination fee normally, to 1 to 3%, it varies, and then 1% annual fee to manage the project, and that can fluctuate, and then 20% of the profit. And that's how we're able to keep going out and finding new deals and pay for things like doing podcasts and investor outreach and all of the stuff that I think those passive investors can benefit from by bringing groups of people together, but maybe don't instantly get that. Even if I had someone invest with us the other day, and they were a commercial broker, and that caught them off guard a little bit, even though they've done commercial deals for 10 years. It's selling them. So I'm sure most of the deals they've sold have fallen into that same camp. They just had never sat in that seat.
Yeah, no, there's 100 different angles we could take with this. I mean, this is definitely I think the topic of like GP or sponsor compensation definitely ends up being kind of a hot button issue. I see it a lot on Twitter, and you get a lot of people with a lot of very strong opinions on that. But I think, man, there's like so many different points here.
So how much is, I've got maybe an interesting one, but how much do you think is too much for a GP to get paid?
I mean, I think too much. It depends. That there's no right answer to that, right? Like I know some people that say that if you're taking any fees whatsoever, then that's terrible. You should never take any fees. You should be entirely compensated on the back end by the way the project performs. And I don't think that's realistic. I don't think that's to your point about paying for overhead. I think the same people that would say that would also get frustrated when they have a question for a sponsor about a deal and they can't get a response back. And that's because that sponsor doesn't make enough money in ongoing fees to be able to hire a investor relations person, and like can't handle some of that low level work.
Or still has a W-2 job and their boss is yelling at them and they can't answer your question. They're busy. They're not getting paid by you.
Exactly. So, I don't like, I think the people that take the very both extremes are bad, right? Like you get people that are saying there should be no fees anywhere. I disagree with that, but a 15% origination or acquisition fees, pretty egregious.
And I think kind of where it was leading with that, and what I would say is, if I told someone I was going to do a 70-30 split, they'd be like, oh yeah, that, or I'll give this example. We just did a deal with a 70-30 split, and they're like, okay, that seems fair. The person brought the money, got 70%. I said, no. I got 70%. The investor got 30%. And that was a flip we just did. Someone brought 100% of the capital. We paid them some interest on their money too. They got a 7% interest. That was nominal for a 3-month hold. And I took 70% of the profit. And it just made sense in the deal, right? I managed the crew. I found the deal. I just needed the capital. And they didn't have to do anything, right? And we didn't take any fees on it. There was no acquisition. There was no brokerage fee. There was nothing, right? It was a simple JV, essentially, right? So the simplest syndication there is out there. 2 people come together and make a partnership. And it made sense. That investor was happy to pay 70% of the profit to me off of 100% of his capital, because the return was high enough, right?
Yeah. And I think that gets, again, like there's so many variations to this, and there's no one right answer. I think there's guidelines, right? And I certainly think if I joked about a 15% acquisition fee being egregious. I mean, I think that's impossible and unheard of. And I think if you saw someone that was asking for like a 4 or a 5,
right? I mean, some of the oil deals that we've done the ones we've invested in have been 15%, but they didn't take any fees down the line other than they took a rev share. But there was no management fee. There was nothing. They baked all of their management fee up front.
Yeah. So I agree. Like
it's a higher cash flowing deal with a higher tax benefit, right? I think the point that we're trying to make here is that every deal is very unique, right?
Yep.
And I heard one sponsor, and I like simple, right? To me, it's acquisition fee, maybe AUM fee, asset under management, and some type of split. You can add prefs, you can add all these other fancy things. And the example I'm about to give is someone had a waterfall. A waterfall is that if you make a 10% return, you get all the money until the investor makes a 10% return. After that, until they get to 11%, maybe it's 70-30. And then once they go from 11 to 12, it's 50-50. And I saw one where they're like, if we can get you to an 18% IRR, from 18 to 19, it's 1090. The investors are taking 10% and the LPs taking 90. And their reasoning for that was that the amount of work it takes me to make this deal go from an 18% return to a 19% return is an abundance of work. I've got to be super strict on my budgets. I got to really manage subs. I got to work the late hours and make sure everything's executing flawlessly. So yeah, you're going to get that extra point, and I'm going to do it for you because I'm going to go make 90% of that, right? So I'm going to go make another $1 million or whatever it is. And an 18% IRR is killer. Yeah. Right. Whereas if you were at the same, I'm going to make another 10% of the deal, well, then the GP might not be motivated to go do that. Well, if that sounds bad, maybe it does, but there has to be a motivation for that person to go do that work. Absolutely. And that's I think that's the big piece here is, you've got ranges for fees that might be common, and you can question if something's outside of a normal range. And again, if it makes sense for the deal, then it's fine. But at the end of the day, it's got to be about alignment. And that's the big thing to really watch out for. And it's one of the reasons why I think fees in general get a very bad rap among certain circles online, because you have certain sponsors, and this has been going on quite a bit and is still going on, who basically do deals for the fees. They take the upfront fees so that they can make some money in the short term, and then they're not really incentivized to do any more work because now they've made most of their money. Or they only make money on a sale. So even if the building's totally performing, they're not getting paid at all. Correct. And that gets to where, as long as I think you can justify more fees as long as the sponsor, the GP, earns that, and they're actually doing the work, and you're getting compensated. And I think, Adam, your example there's great, right? If you're going to make a 17, 18, 19% IRR on something, and then above a certain level, the sponsor's going to take a lot more. Okay. I mean, that seems like an everybody wins kind of scenario, right? The investor's going to do well. I mean, that is certainly a massive performance incentive for the sponsor. And so, yeah, if they can do the work required to squeeze out that extra little bit, then in my view, and I'm aware that I'm biased because I am a GP, but like But even acting as an LP, the deals that I invest in, sure, if someone's, the likelihood of them getting it to if your baseline is that they're not really getting paid a whole lot until obviously enough to make the deal make sense until they get to 10%. And then from 10 to 12, okay, now they're reasonable. And 12 to 15, now they're making some good money. And from 15 above, they're like, oh, these guys they're buying planes. They're doing the things they want to do, right? Like, they're wealthy people. Yeah. Well, they're outperforming your kind of standard investment. And so I'm happy as a limited partner if some guy can go consistently get me 19% and he's so incentivized to do it. It also means that when you get to those upper echelons and the deal starts to take a hit, that guy's got enough money to start fixing things because he's actually making money. And we've seen tons of deals fall apart because the GPs don't have any money because they're just starting out in this. And the sponsors and the LPs don't want to put any more money into it because the deal has gone south. Yep. And then we've seen deals where the deals have gone south. No one ever asked the LPs for money. The sponsors just wrote $1 million check and put it in there as a loan, and they'll get paid back when it sells. And the deal's still going fine. Yep. And I think that's a big difference in when you see GPs that are highly paid and able to do that. Yes. Completely agree. And I know there are people that take a complete opposite view of this and don't think that they're wrong. But no, I mean, I see those arguments, but I tend to agree more with the arguments that you just made. And I think that this gets in, this starts to touch on too, why we don't like in a standard real estate deal, a preferred return. We've got some deals. We've got the credit fund where we have a pref, but that's a different structure and it makes sense there. But in something where
especially if you're trying to have very strong alignment with performance. If you have a pref, and particularly a pref that will continue to accrue, it will accrue in compound. So if it's not met in 1 year, then that just sort of spills over and becomes due in the next. That can become a death spiral for a deal. Because what ultimately happens is the sponsor gets so far underwater if the deal doesn't perform well in the first couple years, they realize they're never going to make any money. And so now they're just kind of doing the bare minimum to keep the deal going along, to not lose the investors' money, but they're certainly not trying to outperform because they've lost all incentive. And so again, this is a very religious divide. I feel like in the syndication circles, some people love prefs, some don't. But I think that I think that they mainly serve for marketing purposes for people who don't fully understand what they are, and they tend to do more harm than good for exactly this reason.
Especially a pref with a catch up to the GP afterwards. That means there's literally zero pref. It's just it's a marketing deal.
It's a marketing tool. Yeah. So I think this is great because Adam, I think when you pitched this, or when you sent this to me earlier, that this idea, it was like alignment. I mean, that's the big word. And I think that's, people can get up in arms about fees. They can think that some fees are egregious, but I think as long as there's alignment and the sponsor is going to earn what they do, I don't have problems with upfront fees as long as they're reasonable, because sponsors have overhead, right? I mean,
there's a random note on that the upfront fees can be taken in a lot of different ways, and this is where each deal is so specific. Like our upfront fees on the credit fund, we accrue them, right? So they're upfront, they're due to us. But we don't get paid on them until your money actually makes the money to pay us.
Yeah.
And so, like right now in the credit fund, we've got, I don't know, $10,000 or $20,000 of accrued fees that won't get paid out till next quarter, because I was on the capital that we raised last quarter. Correct. And that capital hasn't actually gone out to earn the money to pay those fees. That's why the first year's return is a little bit lower.
Yeah.
But we're not depleting the initial investment at all.
Which was a decision that we made, and not everyone makes that decision. Some will take those fees as soon as the money's deployed and then won't deploy all of the money, even though on paper they will show that it's there, but then that ultimately drags down your returns. And so this is a very, very, I guess the big takeaway here is this is a very nuanced subject. If you try to get into black and white binary outcomes here or opinions, that's probably not the best place to be.
I think the thing needs to be that when you ask the GP why there's this fee, they have a good reason for it.
Correct.
And that you don't feel that it's egregious.
And then also, co-invest is another, like there's the GP co-invest can matter in this too, right? If the GP is also putting up a decent amount of the LP money, then that changes the dynamics a little bit. So there's just like, even outside of just purely what the fees are, the structure of the deal, what the GPs are doing, how they're incentivized, how they're participating otherwise, those things can help to, I don't want to say justify, but they can help to explain certain types of fee structures that might seem a little weird or excessive on the outset. So yeah, there's a lot of nuance here. There's a lot of detail. Every deal is different. The fee structure in our credit funds different from apartment buildings or other syndications that we've done. Definitely different from oil funds. So it varies based on the type of deal. And as a passive investor, you want to be looking in. You want to make sure that the GPs are not just trying to get rich off of upfront fees, and they're not incentivized to do that. I think everyone can agree that that's bad. But just because that's bad doesn't mean that all fees are bad. Well, Adam, I think we've kind of covered this one. I mean, we've covered it at a high level, but we could go super deep on any of these. Maybe we will in the future. And if anyone's got any questions or thoughts or opposing opinions, honestly, this is something that will start to elicit some very strong opinions from people. So if you got anything, we'd love to hear from you. wealthindependencepod.com. We got a contact form there. Shoot us a note. We can include it in future discussion on the show. But Adam, you got any other thoughts here?
Nope. Hope to hear other people's opinions.
Yeah, for sure. All right. Well, we'll get on out of here for this one. Thanks everybody for listening. As always, we appreciate it. And just remember, where freedom leads, where wealth follows. See y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.